As Jim emphasized, our aim here is to put questions about how governments deliver on their financial commitments and what ramifications this has for future policy. And in our view, this is a topic that has received too little attention. It's tempting for governments to make promises that will be paid for only down the road, not to engage in responsible cost-benefit analysis. Promises made today alter our opportunities for the future, as we've seen in our earlier presentations and discussions. What we really do is hope that this probe in the second session will flesh out these questions and bring some alternative perspectives to bear. We are not looking for a uniform perspective on all issues. In fact, we expect just the opposite. So the plan is here is to follow up on some of the discussions in the first three presentations by Jean, Carol, and Jeremy. We have three panelists that I will initially pose questions to. And since the answers will connect to the earlier presentations, I will also let the other presenters chime in as is appropriate. So let me just briefly indicate who our panelists are. Ed Glazer is professor of economics at Harvard. He's made a variety of important contributions to macroeconomics in general, and policy, but also is a renowned scholar in both urban and public economics in particular. Joshua Rao, professor of finance at Stanford, senior fellow at the Hoover Institution, and just this week started as principal chief economist at the Council of Economic Advisors. Joshua has done important research on a variety of issues related to local public finance. Now, I've been instructed by Josh to emphasize the following. He's here in his role today. He will not be speaking for the Council of Economic Advisors or for the Executive Office of the President. He will be speaking for himself.
But he will be speaking for the president.
Yeah, right. Yes. So he's here in his role as an academic scholar with expertise on the topic at hand. Finally, the third panelist is going to be my longtime colleague, co-host Jim Heckman, as a eminent empirical microeconomist and with longstanding interest in assessing public policy. So what I thought I'd do is pitch the first question to Josh. In the previous session, we heard much about fiscal challenges, both locally in the state of Illinois and certainly across the country. We heard about budgetary computations based on growth rates and return assumptions. A key issue in all of this is how sustainable our commitments and promises going forward, and how we should think about the impacts of growth and rates of return. Josh, I know from other work, has done important computations on statewide challenges, so I would like Josh to kind of initiate kind of a follow-up discussion then on this important issue. Joshua?
Well, thanks very much, Lars. And I do also want to say for myself again that I was invited to this before I assumed a role at the Council of Economic Advisors. And so everything that I am saying today are my own opinions. They are not the opinions of the Council of Economic Advisors. They are not the opinions of the Executive Office of the President, and they are not the opinions of the President. Clear about that. Now, it's a great pleasure to be here, and I also wanted to say that I'm really impressed that there is a crowd of people here who were willing to turn out for a 4-hour event on the pension crisis. I mean, I was trying to think of movies that I knew of that were, around this length. I thought of Space Odyssey 2001, Gandhi, so I hope that this session is going to live up to be similarly entertaining. So I very much enjoyed learning from the speakers at the beginning, and I think I'll just, by Lars's invitation, take a few moments just to make a few remarks. I think that the idea of fiscal democracy that Gene Sterling outlined is really incredibly important, and I believe that one of the obstacles to fiscal democracy currently working well is that the people, the demos, if you will, don't really understand what the deal is that they are operating under. I'm not sure that it's clear to people how much of their future income has already been promised under these kinds of benefit programs that we're discussing here today. And I think that we play a major role here as academics, as policy observers, and policy observers in making clear to the public just what those liabilities are, and what the situation is. And so we heard from Carol's talk about the situation the state of Illinois is in, and I think that probably people in Illinois, if they really understood the figures and what's behind that, would be really quite shocked to understand just how much of their future has already been mortgaged away towards retirement benefits for public employees. I also want to say a few words about the very interesting paper that Byron Lutz presented. I really appreciate the work that Byron and his co-authors are doing to try to model the fiscal sustainability of pension plans, because I think this is a key question, not just how much the liabilities are worth, which is kind of where the focus of my work has been, whether they're properly measured, but whether they're fiscally sustainable. And so I think that's a great question, and I think he and his co-authors deserve real commendation for working on that question in a very serious way and trying to model these things out and moving that discussion forward. As you may have sensed by some of the questions that I was kind of posing in the audience, I do have some thoughts about the way that the modeling is done in that paper and some of the conclusions. One of the main conclusions of that paper, if you read it, and Byron can correct me if I'm wrong, is that because of the ability of state and local governments to invest in assets that might return a rate of return that's above and beyond a risk-free rate, say, that allows them to contribute amounts of money to pension funds that may actually be less than what's called the normal cost or the compensation cost of the current group of people who are working, which is to say that the promise that I'm making to a given person as a worker might be worth a certain amount of money today. And because of the assumptions that I'm able to make about what returns are going to be going forward, I'm able to contribute less than that, because the real cost of these promises, as I think we know, and I think the authors of the paper agree, is the cost that an insurance company would say you would have to pay in order to meet this promise. It's done under risk-free rates. And I think Byron had talked a little bit about risk-free rates. He referred to a risk-free rate as being 1.5% real rate, which is 1.5% plus inflation. I think that rate is way too high. That's not the risk-free rate. If anybody here will offer me a risk-free contract at 1.5% plus inflation, please contact me after the session. I will be happy to take that deal. I think that is far too high. That is not the risk-free rate. And furthermore, even when you have systems that are taking what appear to be, or who might praise themselves as being fiscally prudent, say a system that might be assuming a 6% rate of return. I mean, if you're assuming a 6% rate of return, you're investing in a portfolio that involves a lot of really risky securities these days, because the bonds in your portfolio, as we know, are only going to yield, for 10-year U.S. government bonds, only going to yield 1.9% today. So you're investing in a lot of stocks, a lot of private equity, a lot of hedge funds, and this was just covered in the Wall Street Journal yesterday. There's a big article about how a larger share of public pension fund assets than ever before are invested in risky assets. And so I think the question you have to ask is it sufficient to stabilize the rate, the ratio of unfunded liabilities to GDP, when we know that those unfunded liabilities to GDP are going to explode when the stock market goes down? It's more than just a question of will that debt to GDP, flatline under an assumption that we're going to make the return. You have to look at the behavior that the pension funds are undertaking to try to meet that return, and that behavior ends up being very, very risky financially. And so what I want to encourage the authors to do is to move in the direction of the stochastic analysis that we talked about, analyzing the fact that in order to target a rate of return, even at just 6% today, you got to invest a lot in stocks, a lot in risky assets. And what that means is that when those things go down in value, if they do go down in value, then you're really in a system that's a lot less stable. The unfunded liabilities are going to blow up, and then what is the government supposed to do? So those are my main thoughts about what we've seen so far, and I'll turn it over to others to keep talking.
Sure. Byron, did you want to?
Yeah, no. Thanks to Josh for the kind words, and I have a couple of responses. The first question, Josh posed it as a question, are the state and local governments able to provide this benefit under our calculations at less than the normal cost, the cost annually, of accrued benefits, because of the return on the assets above the risk-free rate? That's absolutely correct for our 5.5 and 3.5 assumptions, but it's not true under the what we've termed the risk-free rate. So if that's, that is a viewpoint, and if you want to proceed from risk-free rates, we provide those in the paper. I think ultimately it's the policymaker's decision how much risk they want to bear, but you are certainly correct that even under that moderate 3.5%, they are in essence engaging in arbitrage. It is risky, and they are exposing themselves to unpleasant states of the world. That's absolutely correct. It's not the case, though, for the risk-free. As far as the risk-free rate, the risk-free rate, as measured by the Treasury market today, is certainly below 1.5% real. We have measured it over the course of the entire business cycle just to do some historical smoothing so as not to be influenced by, for example, the way trade pensions are affecting the term premium. We want to get at something more fundamental for a 100-year, we're doing 100-year projections. And so we want to do some smoothing. I also would point out that most organizations that do very long-run fiscal projections do much more aggressive smoothing than we do. The CBO has the nominal rate of return going up to 5 in about 40 years, and the Social Security Administration has it going up to 5 nominal in the next 10 years. So we're doing much less smoothing than that. But I acknowledge that the 1.5 is a smooth number using zero coupon TIPS yields over the course of the current business cycle.
I don't believe in the smoothing. I think if you believe in smoothing, then you should be going wildly short the bond market. You should be borrowing all the money you can and shorting the bond market. I did want to follow up, though, on one thing, because even in the risk-free plus, or the 1.5% plus inflation scenario in your paper, there are a number of the Illinois plans that have a negative number in front of the percentage of payroll that would have to be changed in order to make these plans sustainable. But would you advise some of these Illinois state government plans to reduce the contributions they're making to their pension funds in order to stabilize? Are you standing by your conclusion that those are they're overfunding these plans now relative to fiscal stability?
Yeah, I don't think the paper makes that claim. Those negative numbers are for the long-range scenarios. There are not negative numbers in most cases for the Illinois plans for the 30-year scenario. That long run, this is a little technical, but that long run number is fundamentally pinned down by the normal cost in steady state. And because Illinois has enacted these very severe reforms, the normal cost is fairly low. And so the amount you have to contribute in the long run to stabilize is fairly low. However, for those Illinois plans, because of the real disparity between the generosity today versus what's coming tomorrow, in order to stabilize at that level, you're going to draw down assets really significantly, much more than an aggregate for the picture I showed you. And of course, one of the things the policymakers need to keep in mind is, how much of a buffer do they want to reserve to take account of shocks, the very shocks you mentioned, that we may have a stock market correction at some point. I would say most fundamentally, though, they need to make these decisions in the context of their broader mission. They need to decide how much return they expect off some core public investments, which have been really suppressed in the last 10 years. I mean, we're spending 20% less annually on infrastructure than we did prior to the Great Recession. State and local employment is back to the levels it was last at as a share of total employment in the mid-60s. Most of that is in the area of education, which is an investment. And all of this needs to be considered to answer your question, ought they cut the numbers? I do acknowledge, though, that your comment, the Illinois numbers are a bit unusual in terms of the long-run stabilization just because of the really large disparity between the old tiers and the new tiers.
So I'm a little bit curious. We will come back to this. When you say the policymakers need to take this into account in terms of figuring out what the right type of returns to be using. I'm not sure who we're referring to there, what institutions, but I'm going to come back to that question subsequently. I think, Gina, do you have something you want to follow up?
So it's just a quick factoid on this discussion that came up partly in this issue of this 1.5% rate of return. Today, the asset value, the market value of assets held by households in the United States is at an all-time high since World War II. It's about 1990. This is related to low interest rates beefing up the valuation on assets. So we're way above where we've ever been. The only time we've been close to this is 99 and 2006. You remember 99, we had this tech bubble followed by a recession. 2006, we had a bit of a recession as well. And what's implicit, and I don't know if the audience caught all this, what's implicit in these actuarial assumptions that the long-term rate of return is above the rate of return you can get on assets you buy today, which is one of the points being made here, assumes, therefore, that there's a crash somewhere along the way so that you get back to that higher return. So just so you understand that that's part of what's involved in these higher actuarial assumptions, is that you have to have these crashes along the way to get assets and start getting a higher return.
So I'd like to shift gears here a little bit. I think this is a fascinating topic, actually, but let's go on to a different one. As states and cities face fiscal challenges, some economists are concerned about so-called endogenous responses. Faced with the prospects of higher taxes, people and businesses might choose to move, job prospects and housing values may deteriorate. In turn, this may erode the tax base. Carol talked a little bit about this in her talk, but how do we really factor this into our thinking and in terms of doing all these fiscal calculations for states and the like? And are there credible ways to do this, and how might that affect some of our conclusions? I thought maybe I'll let Ed go first if he wants, and then I know Joshua's done some work on this as well.
Sure. So I actually want to just highlight what I think is the primary social loss that's associated with this system that we currently have. And I think actually the largest welfare box that's being lost is actually because the workers, particularly young workers, don't value these pensions at anywhere near their actual cost. Right? The best paper on this is Maria Fitzgerald's paper, where she looked at a 1998 program that allowed Illinois teachers to pay to up their pensions. So it was essentially selling pensions to the teachers. And what she found was that, using her estimation, that the teachers valued it at about 20 cents on the dollar. Okay, so you were compensating teachers with something that they think 80% of it is wasted. Now, that's not completely crazy if you think about it, right? There are no other areas of the economy that have pension systems that look like this, or very, very few, right? These are not consumption patterns that you see in most of the data. And certainly when you talk to a young teacher or you talk to a young police officer, they're desperate for cash to handle their problems today. They're not sitting there thinking that it's a fantastic thing that all of their consumption is backloaded to when they're 78. Now, what does that mean? How do you think about this waste, right? So the one way to think about this, just to have an image in the back of your mind, is imagine if the U of C decided that they had a whole set of administrators who they were paying $60,000 a year to, and they were going to pay $50,000 of that they were going to pay in cash, but the other $50,000 they were going to do, they were also going to do a 50-50 mango and cash split. Right? So they were going to spend $50,000 on mangoes and give that to workers, and then $50,000 in cash. But the problem is the workers don't value the mangoes at $50,000. They didn't want $50,000 worth of mangoes. They only wanted, a few $100s worth of mangoes, and so that $50,000 is only worth $10,000. Okay, and that's exactly what we're doing. It's like we're throwing out $40,000 worth of compensation every time we up those pensions. Now, why do we have this system? Why is it that this goes on? This relates to things that everyone has said. The fundamental thing that pushes us towards the shrouded costs of government is the fact that it is much more difficult for voters to figure out how much a pension promise costs than it is to see what cash costs. Right? So a cash compensation is very obvious to everyone. A pension promise, particularly wrapped around a promise of a 7% return, or in the old days, right, a 10% return, right? 10% return costs nothing. And so, if you're promising people that you're going to pay for these pensions with investments that are going to yield 10% a year, then how is the voter going to figure out about it? The one group that is able to figure out how much it's worth are the actual public sector unions themselves, which are smart enough to sort of know what's going on. And so it's this lack of transparency that really pushes the political economy towards pension promises. This does suggest that there may be something of an arbitrage opportunity here, in the sense that the state and localities can actually reduce some of their future benefits, not by actually zeroing out, not by breaking the contracts, but actually by offering some of the people who are in the Tier 1 programs the ability to get upfront cash instead of those future promises, which may be a way to avoid some of that. But I think going forward, the only way, and there are really two questions, one of which is sort of how do we deal with the current mess, and the second is which is how do we go forward. I think the most important thing going forward is transparency. I think the critical thing is to move, as the overwhelming majority of private sector employers have done, from defined benefit to defined contribution plans. Right? It's not that a defined contribution plan is perfect under all circumstances, and among workers who are getting, who aren't in Social Security, having some form of lower bound doesn't make sense. But the beauty of a defined contribution plan, it is transparent. We know exactly how much the public sector is giving away when they write that contract, and it's not something that gets shrouded in financial returns where, we've heard this argument between Byron and Josh, and you can be forgiven if it's a little bit difficult to figure out what the voters would take away from that. But something that creates some form of transparency in this is the only way I think that we get towards long-run sustainability of this, because of the politics more than because of the finance.
So
can I just give a simple example of why it's not transparent? I just like to.
Just a second. Can I just chime in here for a second? Ed has done a wonderful job of ducking my original question.
I will. I'll come back.
So now let's shift questions
Okay.
along the lines that Ed has proposed. And so let's really talk about things like what were the causes of these type of problems? What are the ways to correct the political institutions in order to address them, and what are the
I
viable
didn't want to
changes?
duck. I just wanted to get what I thought was the critical thing that wasn't on the table.
Please.
On the table.
So I will now put a new question on the table to which Ed has given his answers, and I'll let Josh go next.
So the system of accounting that the public sector uses for defined benefit pension plans would in the private sector be viewed as fraudulent. So if you're the police chief and you're going to retire in 10 years and your first pension payment from me is $100,000 and I'm doing the budget of the city, I'm allowed to set aside only $50,000 today and declare to the public that I have no debts to you, because that 50 is of course going to double in 10 years, more than double in 10 years at the rate of return I'm assuming. So the basis on which all state and local governments are proclaiming that they have balanced budgets is actually fundamentally fraudulent and needs to be changed. Now, who's complaining about that? Well, the taxpayers, they're not really aware of this. And this is math, and it's sort of, it's kind of hard to understand, sort of, abstract. And the governmental officials themselves, someone referred to, or maybe this was at the break we were talking about, how the horizon that a governmental official might have may be too short to really care. I mean, if you can kick that down the road, it doesn't really matter. You're not going to complain. If you and if I can make this promise to you, and I can leave it to Ed, who's going to be the next government official to deal with this mess, then I'm fine with that. And of course, the employees are okay with the idea that they have a permanent lifeline on the taxpayers, as is enshrined in the Illinois Constitution, that pension benefits may not be diminished or impaired, so you're okay with it as well. So it seems to me to be a system that is just basically fraught with agency conflicts of interest, really between politicians and the public most of all. And so that's where I see the problems coming from.
But how would
do
you
we
reform
address it?
Yeah, how would you reform it?
Defined contribution
Practically-
plans. Ed is exactly right. Defined contribution plans. And, one of the
But
reasons...
those are resisted every time those have been proposed.
They've been resisted. And let me tell you...
Tremendously with
Where are you
public
gonna find the
sector
money?
unions.
Where
No.
are you going to find the money?
Well, that's another issue.
I mean,
For sure.
because
Well,
I mean,
it's
the,
a huge
the,
issue.
the Ponzi scheme nature of the pay-go, the defined contribution plans, not a penny from day one can go to pay towards anybody else's retirement benefits. So you're right, you're not wrong, but from a practical perspective, I don't know
here's how it would
you
have to
do
go.
it.
Yeah, you completely destabilize the existing system
Yeah,
because
you'd
you
have to-
derive it of the
have a-
inflow of revenues, and you have this massive transition issue that you have to fund. You bring forward the date of insolvency greatly.
Yeah,
But
no,
that's
it's-
no reason to keep a Ponzi scheme going, because I think here's the way that you would transition to it, which is that if the state of Illinois really woke up and got fiscal discipline tomorrow, then what they would do is they would close all of the defined benefit pension plans to new workers. They would freeze pension promises where they are now, and they would compensate people going forward on a defined contribution plan. I'll tell you where the money's going to come from in a second. Not a cheap 401k plan, like, people like to cite some 401k plans in the private sector that have a low employer match, but a really decent one, like a 10% of pay defined employer contribution to your DC plan. I think there are a lot of young public employees who would really like that. So you do that, and where are you going to get the money from? Look, the fact is that this state has over $300 billion of unfunded liabilities. That's not going to go away. Nationwide, you have over $4 trillion of unfunded liabilities. That's not going to go away. So the only way to deal with this is going to be to use borrowed funds to deal with it, to be able to issue government bonds, to be able to bridge this gap, but not before you have totally reformed the public finances so that you are not making any more new defined benefit promises, because otherwise you're just gambling with borrowed money. But the only way to do it would be to freeze the pension plans today and borrow, and that's what companies have done when they've dealt with this issue.
I mean, there's no reason why, look, the Ponzi scheme thing is basically saying we're going to figure out some way to tax the existing workers to pay for the old workers, right? There's no reason why that makes any economic sense. The only reason it makes any sense whatsoever is because of the politics of it. It is absolutely true, and this takes us back to the question that I ducked, that we're going to need to figure out, to handle this debt, we're going to need to figure out which tax revenues are actually going to pay for this large amount of debt. But I also think, like, just in the spirit of this panel, I am not feeling constrained to say anything that is going to get me elected governor of Illinois, just to be entirely clear, or even to, we're trying to be true to the economics here, right? Not necessarily to any form
Absolutely.
of politics. Yeah.
I just want a little reality.
I would like to return to my question.
If you don't mind.
Maybe nobody has a response to it,
This
which
is
is fine, or
Chicago,
maybe it's
isn't it?
trivial. What?
This is the University of Chicago, isn't it?
Yes, I know. I'm aware of this. So in terms of doing these calculations, we talked about things like potential growth in wages and the like. Faced with the prospects of higher taxes, how do we attract new businesses? Does this affect job prospects, housing values as well? Illinois can make its own ways to try to accommodate things, but aren't they constrained by some type of endogeneity in the responses? And when you're doing these budgetary calculations state by state, how do you really take this into account? And is this a quantitatively trivial matter, or is this something that's quantitatively important?
But isn't that generally true in public finance? That people don't look at the response of the system. Forget about any of these pension questions. Just look at the income tax. That's a huge debate to this moment, isn't it? To sort of look at what responses would be, labor supply, tax avoidance, and all that, and computing the benefit of a tax. So that's a larger question, is how you're going to get that into the system.
Absolutely. So we could happen to put the larger question on the table, yes.
But there's no incentive. If you look at these, how many hundreds of different units we have here in Illinois?
Thousands.
1,000. That's a lot. We have the largest number of governmental units of any
Six or seven or 8,000. Yep.
Yeah, we're larger than California, Texas, and Alaska. If you want to go back to your example. No, but really, what's that?
Combined, just about.
Combined, yeah. So the question then, you have all these individual bureaucrats, or whatever you want to call them, politicians, people, local officials, that have a very limited sphere. They can issue bonds, they can do things, and they have no reason to kind of coordinate in any sense. Nobody's looking at the externality. That's why I'm worried about this notion of saying, oh, we're going to benefit a lot from kind of putting together these pensions. We're going to benefit a lot, or people are going to shuffle off to the larger pool to do things that they should have done by themselves. So it's this disaggregated, isn't it true? I mean, I don't know this, I've heard a story, I don't know if it's really true, that the reason why we have so many of these districts goes back to the 19th century.
Yep.
And it was that basically the early leaders of Illinois thought, let's cap the amount of money you can borrow, right?
Yep.
So the solution was to form lots of other government entities so they could all borrow. And so we've inherited the benefits of that.
There was a provision in the 1870 Constitution of Illinois that didn't go away until the 1970 Constitution that prohibited borrowing over a certain amount by local governments. And so the solution was create a new local government.
You get a water district, a school district.
Street lighting.
Sewer, street lighting, and for that matter, any other district.
Mosquito abatement.
But the political economy, I realize none of us really are that good. There's some people in the room who are actually probably more knowledgeable, and I think they should contribute at some point or even now. But literally, it seems like a very, very difficult question, very difficult problem to kind of shake the inertia, partly because of knowledge, right? People don't know the facts. And secondly, the incentives in the political system are just not to solve this problem. I don't know who has, so we're talking about the decision maker. There are a bunch of decentralized politicians trying to get reelected in their sewer, water, mayor, whatever district. They have no reason to try to internalize any of these things or coordinate.
The complication for me is has risen to, with a small c, it's risen to be, to me, a constitutional issue. I don't mean the U.S. Constitution.
Yeah.
But a small c, it is so fundamental. We've gone so far. It's not just in state pensions. It's across the board,
right.
Federal, state, so on and so forth, and making these commitments that we've totally stymied ourselves. And we really have to come up with some rules that go far beyond what we've had in the past to try to get at it. I mean, one minor one, I do, this is a little bit totally out of my field. We close to having a constitutional amendment for equal rights for women. We're like one state short. They say Virginia's going to turn it. We've got rules in the law. You can't discriminate against the old. You have nothing in the law that says you can't discriminate against the young. Now, I'm not saying that's the right type of constitutional rule, but by constitution, I mean law rule. But we need some rules that establish equity and other standards that force us to address these issues and force the type of transparency that I think everybody in this room, or at least on this panel.
But I worry about the fact you're going to entitle yet another group, and there'll be more, the people, whoever they are, representing the young
I'm talking
children.
about equal rights.
Well, no, I'm not talking about equal rights. You're talking about children.
I have an actual answer to your question.
Go ahead.
Good.
please.
I would like an answer, yes. Thank
And
you.
it's not really an answer, but so
Still waiting.
The concern about the state's pension plan or pension situation is something that has reached a lot of people's. They don't grasp it fully, but it is in their consciousness out there in the public. I mean, that happens a lot. Over cocktail parties, randomly, if someone finds out I go to Springfield, they're like, "What are we going to do about that pension?" They don't get much of it, but they ask that question. And you talk to businesses, and frequently they know there's a concern, and they're worried that there's going to be some tax increases to pay for it. And so as a result, they are paralyzed and not making investment decisions and not increasing their Illinois presence. And they've often said, let us know which shoe is going to drop when and where, and then we will invest, because then we will understand and know what's going on. So some of the answer is, we just need to figure out what the solution is. And it may drive some people out, but it may also keep some people from leaving who are right now not coming here because they're worried.
Are you,
That's not really an
suggesting,
answer.
are you suggesting, so what kinds of constitutional small c changes are we looking at? I mean, because I think
Good try, Carol.
I want to raise the question of whether
So you're at the
are we going to is the solution to this would the solution to this impact accrued and earned benefits? For example, payments that retirees are already receiving. Is that a place to go, or is the way to do it to wall off all of the accrued promises that have been made? Say we're going to honor those. And then going forward, we're going to make sure that we don't make any new unfunded promises by, for example, we're going to introduce DC plans, 401k plans instead of that. I've tended to favor the latter, but I think I'd like to hear some discussion because I don't know what people think about this.
Well, wait, but going forward, the way Gene was talking earlier, just look at public schools. People are saying, okay, I mean, even in the last budget, the Rahm Emanuel tax increase, a huge amount of that went to paying off the pensions, not to building better schools. So here's a question. I mean, you have a real trade-off here. You're going to spend more money on retirement benefits for school teachers or at the cost of educating these children? I mean, there are real trade-offs. So I don't know why we don't go a little further and simply say, given that promises were made, they can't really be kept except at enormous costs, we might want to break some of those promises or at least put it on the table. I mean, maybe you say, I never break my promise. You're a very moral guy. It's good. But the cost is going to be enormous, though, I think.
But hasn't the Illinois Supreme Court made breaking promises somewhat more challenging?
It could be on the Constitution. You can vote on that next year.
We can vote on that.
You can put an amendment.
They put a ballot provision on the, that would be amending the Constitution to allow progressive income taxation in Illinois.
Yes,
but they
exactly.
have not put something on that would allow this issue to be.
There's always bankruptcy. I mean, there are other
Wait, but
options.
can a state go bankrupt?
No, not exactly. But
Exactly.
there are certainly plenty of states that have reneged on debt over the
But
centuries.
cities
as you
can
know.
go bankrupt, right?
Absolutely.
So maybe
In some states.
And special
Chicago
purpose
should
districts
take
surely
all of
can.
the Illinois debt and go bankrupt.
Not in the legislature has to approve the bankruptcy.
Yeah.
Correct.
So in
Okay,
typical
sorry.
Chicago fashion, can I go back to question 3 prime?
Please,
And answer
whatever 3
Joshua.
prime is. But yeah,
So
you might
what
want
I've written a lot about, but I think you have to do it program by program, is I think the general rule that has to apply is that legislators cannot build growth into programs that make such excessive promises on the future. If you actually get the growth, not necessarily existing promises, like, keep Social Security benefits where they are for everybody, keep, retirement benefits where they are. If you can actually control the growth factor, then the economic growth over time gives you the additional resources to do things. And then you force, in that system, you force the decision-making back to a budget process where interest groups compete. We might not get what we want. I mean, I actually want to pay teachers more, by the way. It's something that's on my list, but I could never get there by the system we have. So rules that start getting at that growth factor, I think, are crucial because we built so much growth. And that's what I tried to point out that early slide. We've never been in a system until the last couple of decades where the growth in spending is preordained to grow faster than revenues almost everywhere. That's just not a viable system either economically or politically. You can't have legislators being forced to that their job is to renege on promises. It just can't work. You can renege on 1 promise or 2, or you can have some growth that grows faster than the economy or thing. You can't do it across the board. So that's where I look for constitutional fixes. I guess in the state pension plan, it probably means you do have to do something that allows you to freeze some level of existing benefit, which I gather is now ruled as unconstitutional, but that would be one way, for instance, to control the growth there, gradually convert to something else or something else like that.
But I think even the
but you're not
cost of
there.
living adjustments by themselves, I mean, those could be controlled,
Yeah.
right? I think they're beyond the actual inflation rate now in Illinois, aren't they?
Right now they are, but
Yeah.
that's contract. That's part of the contract.
So let me
I know, but
let me go on here.
that's a good deal if you're a teacher who stays around. But look, seriously, like this tier 1 and tier 2 you're talking about.
tried.
No, seriously. I mean, okay, so you have these 2 plans that people were somewhat pleased. You could sort of balance it off. But those people who are now getting much lower benefits, I mean, those are the next generation of teachers and people coming into public service. So we're going to lower the quality of public service with that kind of solution, right?
If they care about pensions, which is something.
Yeah.
Well, no, he's saying you don't, and that's good. So we can really exploit that knowledge.
Well, and we can make them better off without. But
I understand. We can do that.
Excuse me, can I interrupt you?
What are you,
No, you're ruled out of order.
Excuse me.
So I do want to follow up here in the sense of, this goes back to Gene's talk as well. We have all this commitment to expenditure. There's little flexibility. What are the costs we're really facing as a society, with our hands being fully tied in terms of the provision of public services, all the way from rewarding good teachers as opposed to teachers' unions, or in terms of other type of investments in infrastructure or the like? Have we kind of mortgaged our future here in terms of the current commitments, and what really is the social or economic cost attached to it? Is it substantial, enormous, or?
I think the right view is just this is we've incurred a debt. We've got to figure. I mean, I'm completely on the Josh Rao front that we want to firewall this thing and figure out a feasible way of paying for it. And that doesn't make it impossible to invest more infrastructure, but we need to figure out different revenue streams, right? Mm-hmm. So that means, I mean, I've long been on the path that infrastructure, the best way to fund infrastructure is with user fees, right? That in fact you don't particularly want to subsidize people to drive longer distances or to fly. You want to have user fees pay for this. I see no reason why that should be crowded out by the fact that we happen to owe a lot of money to a bunch of teachers. Paying for that debt is going to be costly. There's no question about it. But there are more or less costly ways of doing this. I mean, I think the best paper that sort of looks at the migration effects of business taxes is Josh's. He hopefully will say a little bit about that. But and this was exactly the question that Carol raised. What's the right mix of taxes? Now, at the local level, right, the most non-distortionary tax is, of course, going back to Henry George, right? It's a land tax, a pure land tax. Now, you've told us that we're high on property taxes already in Illinois, but it is going to be less distortionary, and it presumably doesn't cost huge amounts of outmigration. It will unquestionably be felt in terms of property values. But much of that property value may already have been anticipated in terms of the outlying debt. So I think this is an issue that it's bad that we owe all this money, all right, and that's an unfortunate thing. But it doesn't make it impossible to invest in children. It's just we need to sort of recognize that we're going to need different revenue sources to do that, and not let this. Maybe we do want to break or not. I'm not going to opine on that. But we need to sort of separate the fact that we shouldn't let the fact that we've had a sunk cost get in the way of our investment decision with other.
I agree with that, but I'm still not sure if people overpromised. Maybe we should have the former mayors come together and pay the $300 billion or whatever. No, seriously. No, seriously.
Good luck with that.
I mean, honestly. I realize people, that sounds terrible, but they could become wards of the state. There are other programs. But quite seriously, it's not obvious that, these promises were false promises. So why doesn't the system give a little more? Why does it have to be just one part of the system that gives? Because these higher taxes aren't going to be. So Josh, you should really talk about your paper suggesting something similar to what Pritzker is proposing here in Illinois, right? What the effects were in California.
Right. So Ed referred to a paper which is a paper about business taxation and companies moving out of states. That's the Journal of Political Economy paper, right? And Jim is referring to a most recent paper that I've written, which is on the progressive income tax in California. So in California, the top income tax rate is 13.3%. Now, it's only on singles earning more than $500,000 and couples earning more than $1 million. So these are very, very high earners. However, in California, a lot of the budget is actually reliant on these individuals. So, the typical stat you hear in California is that the top 1% is paying for almost 50% of the entire individual income tax. So what we did was we looked at the introduction of the top tax rate in California and tried to look at what people's behavior was. Using very detailed administrative tax data from Sacramento, from the state capital. And one of the challenges to doing this analysis had been that, if you just looked at the macro situation, California is a macro sense because the tech industry has been doing pretty well. And so the state was just looking at their revenues and saying, well, it seems like revenues have been growing. But what we're able to do by looking tax return by tax return is a couple of things. First of all, we can see the people who are leaving. And when Prop 13 was put in, Prop 13 was the legislation that spiked up the top tax rate from 9.3% to 13.3%. When that went in, there was an increase of over 40% in the departure rate of people who were put into these top brackets. So there is a big spike up in the rate of departures. And secondly, perhaps even more consequently for the state's coffers, there was a big decline in the reported income of the people who stayed, more than you would expect just based on kind of mean reversion. And so the bottom line is that the state is now only bringing in 40 cents of every dollar that they would have expected to bring in when they assumed no behavioral response. Now you can look at that as, people who want to look at that as the glass is half full would say, well, it's good, we're not on the wrong side of the Laffer curve yet, or we weren't back then, because at least they got 40 cents, instead of 0. But since then, there have also been some major policy changes, namely at the federal level, the elimination of the state and local tax deduction. So anybody who lives in a state where there are relatively high state income taxes is going to feel, an additional wedge opening up between the state, between being taxed in California if you live there, or versus, your decision to maybe move to Nevada. And so I think that when you put those things together, the ability, at least of California, to raise more income taxes by increasing tax rates is probably not there, that they are probably at the top of the Laffer curve or on the wrong side of it now.
And let me just emphasize, the fixed assets that California enjoys are much larger than those that either Massachusetts or Illinois enjoys, right? Between their climate and just this tech industry is just a thing which would keep the skilled more fixed than it would be here.
Yeah.
Thank you. We finally got to my second question.
You should have asked Josh at the beginning.
Yeah.
Well, apparently so. Let me just follow up on this point. It's kind of related but distinct. So when I read proposals about revenue generation from tax increases, say here in the city of Chicago, for instance, they often seem premised on what an economist might call inelastic demand. For instance, in Chicago, we read that we're going to tax food consumption at restaurants, we're going to tax ride sharing, and they're given some number of revenue which is going to show up accordingly. But it seems, at least in the longer term, there'd be reduced demand, it would affect potential job losses and the like. How do we credibly include such adjustments when we're talking about any type of tax changes? Or are these considerations truly second order? They seem to be just out of the public discourse.
I think they're unknown. I don't think there's so much known, right? Can you go to a list of where you could find how many fewer people will go to a restaurant as a result of a 3% increase? No, I honestly think that's not that high.
Empirical microeconomists, I thought that's what they're supposed to tell us.
That there's a lot less research in microeconomics. It should be more fully funded.
We need more of those people. We need more
And
of
at
those
the
people.
expense of retirees.
I knew we were going to get that somehow.
But seriously, it is underfunded. But even more basically, forget about this. We're talking about what efficient government is.
Yeah.
I mean, and I know that literally the kind of work on cost-benefit analysis and the notion that in the 1960s and 70s they're trying to get efficient expenditure, that's kind of died. Yeah. Nobody's doing cost-benefit analysis. Nobody's even justifying in terms of rate of return on anything.
One response to Lars's point is that it is certainly true the standards in microeconomics have gone up, so our accepting just some relatively mediocre estimate of a demand elasticity that's not as acceptable anymore. But that doesn't mean that your posteriori should be it has no effect.
Yes.
Right? We need to have something that we think is our appropriate posteriori to stick into these things. And it's almost assuredly true that almost every elasticity is going to be larger at the local level than it is going to be at the national level, because there almost is always a geographic adjustment that is possible that's big. Yeah. One of the things that's been ringing through my head since Gene's comments of an area in which we've never had any cost-benefit analysis is one of the great ways in which the old have nailed the young is with the changing regulation of housing production in this country. That in fact it used to be possible to build housing almost everywhere, and now we have protected incumbent homeowners by making it virtually impossible to build new housing in places like coastal California. Not a single one of those regulations, which have completely changed America's housing markets and changed, in fact, the way Americans live, has been subject to cost-benefit analysis ever. Okay, and that is sort of an absolutely vital need in terms of local regulations as well as local
and a major
housing.
cause of resegregation by class, particularly economic class.
Yeah. But see, I think it's generally a correct point that we don't even worry about this question. It's not on the public radar.
Yeah.
I remember Jim Paterba was telling me a few years ago that public finance economists consider it far too boring to work on cost-benefit analyses or rate of return analyses. And I think he's right. You're not going to, if you do rate of return on something, but it's so vital. But maybe nobody believes the numbers anymore, so maybe it has no role. But without that kind of analysis, how are we going to make any hope of getting good or efficient government policy? So I like the idea of the cost-benefit analysis in these housing policies.
For any local regulation, every
exactly.
occupational licensing,
Right,
you know,
right.
the barriers to entrepreneurship at the local level.
You know, I do a lot with the foundation sector, and it basically follows a herd instinct. And the latest mantra is cost-benefit doesn't matter, big policy doesn't matter. They want to have randomized control trials to find little $1 million projects. Although I know Jim's done some great work with some of these, but as if you're going to be able to discover how to reform Medicare, or Social Security, or public pensions by doing randomized control trials. It's just not there. But then they've abandoned the broad public policy issues where we've got trillions of dollars floating around, and basically almost ignoring it.
Well, I think what I worry about is a general movement. I mean, you could comment on this in economics. Among at least certain groups of economists, it's kind of giving up on being able to answer those questions. So therefore, a bad answer is going to lead to rejection. You're not going to get any recognition. You're not going to get any support. So I honestly think there is a move away from this, right?
I have a very hard time believing that if you really write credible studies showing that these demand elasticities really matter in public finance, that gets no attention in the academic community. I mean, maybe you're right.
No,
I think
the demand
level cynicism to me.
It does, and there are some good studies on the demand side of demand elasticity. I think what's very difficult is, we can measure the costs. We can show that certain things are not going to generate revenue because there's going to be so much behavioral response that it won't. The difficult thing is measuring whether there are what the benefits are. And if you believe that the tax money is going to be essentially wasted, then obviously the benefits are very, very low. If you believe that it's not going to be, or it's going to be spent on things that are going to lead to human capital accumulation, other beneficial things, then the benefits could be higher. And I think that's where it's very, very difficult to be able to, for at least our profession, as we've been practicing it recently, to be able to say anything.
Well, and you all can figure it out, but it might not matter unless you can write reports that don't use words like endogeneity and stochastic in them and stuff, because the legislators.
Love those words.
Because the legislators who enact the policies that you are trying to advocate for or against, they can't look at charts that use, have all those beautiful. I mean, it's very difficult, even if you could figure out the answer.
But suppose you
translate it to
couch it in
someone
the form of
putting it
saying,
into.
are people completely wooden? If you double the price of something, will you buy less of it?
They get it.
I think they get that.
Well, and
So I think
in
it's a little matter of packaging.
In his defense, the governor's fair tax proposal, when they passed the legislation, the $3.4 billion or whatever it is, they have baked in an estimate of, they call it planning, where there will be some loss. But I'm sure they did one of these to figure it out.
To me, the bigger dilemma on the tax side is if you look at what the politicians are saying, watch the primaries now, or watch when they get to the presidential election, is basically for the middle class, which in voting terms is defined as 95% of us. The basic argument to the middle class is there's a problem out there. You are not responsible for dealing with it. We're going to zap the rich if we're a Democrat. We're going to go after welfare recipients if we're Republicans, and that's going to be 1 or 2% of the population. When the middle class, people in this room, get most of government benefits, pay most of government taxes, and to think that we can be excluded from the calculation.
And doesn't that feel like it's a danger to the California system? Doesn't it feel like it's when you basically put the tax burden on the top 1% alone? Doesn't that feel like you get very irresponsible decision making by the median voter? I mean, because they're actually
I'm not
it's
opposed to
exactly
increasing taxes on the rich. Don't get me wrong, but it's like that's not going to solve these issues.
Yeah.
So you've been listening to some of the primary debates. That's the median voter is really happy with that idea.
Yeah, really. So before I turn this over to audience questions, I just want to just go around the panel one more time. We've gotten lots of discussions about this. Lots of people have done a good job of identifying flaws in the current political system and what the problems are. What do you see as the best solutions going forward? I mean, some people have already commented on it, but if we can get some type of summary statements from the various different panelists before I open up to the audience, I guess I would appreciate it, so I could see to the extent there is any type of agreement or coherence on what are the positive steps forward. So maybe I'll start with you, Byron.
Well, I think the work I displayed outlines one path forward, which is to try to move towards sustainability. And echoing some of Carol's comments, that is going to require raising some additional revenue to get there, and there's probably no avoiding that under current, the current legal framework.
Gene, did you want to?
Can I? Well,
Go ahead.
I'll have my chance.
Yes, you will. Yes.
So at some level, I actually think the economic issue is easy. I mean, I think we could come up with some compromise, taxes, changes, freezes, so on and so forth, which would get at the problem. And as I say, if you get the growth rate in these systems under control, gradually over time, you're going to have the flexibility to do things again. The issue is political, is how do we convince the public? And for the public, since a lot of these problems seem to be in the future, well, that's when the state system collapses or some city declares bankruptcy or finally the Fed debt explodes. I think the pressure, and what I've tried to do with some of my slides now, is try to emphasize we're paying huge costs now. I think that's how we're going to get at this issue politically, is the public has to be convinced we're paying the cost right now for what's going on. It's not in the future. It's being now, whether it's these new workers that are not only paying for old workers in an inequitable way, but aren't getting COLA adjustments that are threatening them in retirement, or whether it's much broader issues. I think the public has to understand that the cost politically is now, and then I think we can come to the economic compromises that we would need.
I think, I mean, I was mostly kidding about my endogeneity comment, but I do think that whatever, no, it really wasn't, you're right. I don't know that I have a solution, but whatever the solution is that you all come up with, I do think
Here, look at these guys might up there.
the key to getting it accomplished is to translate it into actual doable things that are understandable both by the public and by the policy makers. To me, that's most important.
I just come back to this question. We haven't really talked that much about taxes. I mean, it's in the background. But there's a lot of work, I think, that is good in public finance that does show and is convincing that if people feel they're getting a benefit from the tax, it has very different effects on behavior, on housing values, on just about everything. So, for example, in some of the reforms in Latin American countries, when payroll taxes were installed, but nonetheless the social security systems were reformed, there really was a wage adjustment. So there really wasn't much disemployment because workers were willing actually to take lower wages because they got much better benefits for what they were paying in terms of the tax collected. So I think another aspect of governmental reform is providing some kind of real recognition that it isn't just rip-offs. So we're not just kind of, I think there's a perception, at least here in Illinois, that a lot of the public expenditure is just going to line the pockets of, and there are plenty of people going to prison now or about to go to prison per se. But that's the point, that there's a revenue side for sure, and it can be distortionary, but it doesn't have to be. You pay very high taxes if you got benefits back, but I don't think many people see they get the benefits back. And like in the public schools here, if you're paying most of your tax increase for pensions, and the school system still needs a lot of work, then there's no perceived benefit. Nobody, unless you build altruism into the system, which I don't think is something to rely on too much, that I really don't think that, so I would really think about reforms both at the tax level and at the expenditure level, and guaranteeing what's going on with the money that's being spent. I don't know if pensions really do that, to be honest.
Yeah, that's much bigger than I'm going to go. I mean, but I'm going. Carol's going to tell me I'm being ridiculous anyway. But I would, within the state, I would standardize. I would standardize not just management. I would standardize rules. That's not something that's all. I mean, Massachusetts has much more standardized rules than you do across pension systems. So I would get rid of a lot of the local discretion. I would do as much as you can in terms of firewalling the existing systems and figure out an alternative revenue stream to pay for them. And going forward, something that looks much more like defined contribution rather than defined benefit. And I want to just highlight two additional benefits of that. One of which is, I think it's a great model for young people to do a little bit of teaching in their 20s and go do something else. Right? I think that's an absolutely reasonable and sensible model, right? We shouldn't be thinking that we lock everyone in. The current system, as Gene's graph showed us, we're all about locking you in order to get the benefits. And the part of the beauty of a defined contribution plan is you can move. The second thing which my student Val Bolotny showed with the Massachusetts transit workers is that in fact these allegedly gender-neutral plans can end up being wildly unfair between men and women. Sure. Because in fact, if you have a plan that bases the size of the pension on how many hours you worked during your last year, right? 55-year-old guys are perfectly willing to let everyone else in their family hang so that they can like max out their hours. Whereas their equivalents who are women actually have people they need to take care of. And actually cannot then go and do that. And so you end up having these huge differences in terms of total compensation between the genders because the different gender norms within the family. And that's also an issue. But I want to sort of end my last point that, like, yes, on one level, all this is completely unrealistic. But there was another point that was sort of larger in this, which is, and it's related to what Jim said about past generations of economists engaging more in the public sphere, or all of us, right, who are passionate about public policy issues and try at least to pretend that we're informed. Then, in fact, this only works if, in fact, the people who are informed actually take action. I mean, there was a time when a 3-term senator, right, from the state of Illinois was a U of C economist who, in fact, had done major work in what was mathematical economics at that point in time, right? Paul Douglas was actually, and Milton Friedman's contributions to political discourse were enormous, right? None of us, even the greatest, have had contributions in terms of public discourse on that level. And, that is should be part of our job descriptions, as well as actually turning out papers that have, lasting impact.
Could I ask him a question?
Sure.
I'm
Go
a
ahead,
co-organizer as well.
Please.
Well, I'm asking a question, not making a statement. But every time there's been an attempt to sort of get rid of these defined benefit plans, my sense is the public sector unions, and this is what we're really talking about here, more or less, right, in these pensions, public sector pension, have resisted mightily. And then there's a larger question about, the power of the public sector unions. Again, is that something that should be taken for granted, that they have a right to sort of hold up the city or hold up the state? Are there successful cases? I think, look at Kentucky. Kentucky was trying to change its pension system, right? In this massive strike. I think Oklahoma too, right? And so they shut down the school system across the state. They're very highly organized, and unfortunately, the bargains between the public sector unions and with the bargains of the public sector unions and the cities, which represent not even the taxpayers in the city aren't even involved in that, right? They really are not engaged. So only indirectly, when they elect these officials.
So I would just note that it seems like it's a very different thing and a much less healthy thing. When you have employers who are representing shareholders bargaining with unions who are representing workers, that's sort of one thing.
Yeah.
But when the employer, one side, is actually elected by the same workers who it's allegedly bargaining with, it does appear to be something innately unhealthy about that system.
Correct.
And it is something I think that we should all be concerned about. I think in reality there will have to be a buyout, and I mean there needs to be some form of I will say certainly the 10 years that I spent involved in the sort of education reform. The extent to which I watched the reformers around me who came in wanting to go battling with the public sector teachers unions like nobody's business, and after 10 years of losing every battle, they decided we need to buy them off. There's only one way. That's the only way that reform happens in this country. So I want to be with you at I want to be with you at the barricades, Jim. But I'm just not totally sure that we're likely to win this one.
Well, can I ask you? Let me just ask him one last question. Detroit went bankrupt. It did get rid of a lot of its debt. What were the consequences in the pensions that came from that? I don't know the details.
Very small. The pensions, I mean, there was a cost of living adjustment reduction. Basically, you hear the statistics you read are that in Detroit, creditors, bondholders lost 90 cents on the dollar, and pensioners lost 4% of the value of 4%. Their 4%. Now, there's a debate about what percentage of the unfunded liability did they lose. That's probably a bigger number than 4%. But the hit that they took was 4% of the value of what they otherwise would have gotten.
So that's not a
So
solution.
it seems to be that public pensions are de facto. And what's interesting is in that case, Michigan has a vested rights doctrine in its constitution, kind of like Illinois does, that the pension benefits may not be diminished or impaired. The judge, however, gave the city the right in the bankruptcy to negotiate an outcome that would have involved much larger pension cuts. But the judge isn't going to. They don't cram down a solution onto the city. They just say what can be done and what can't be done. The de facto seniority of the pension benefits is a problem, and the reason is, imagine you're negotiating an exit from bankruptcy in Detroit, and you've got a sort of bunch of finance people wearing suits with a stack of papers saying we're owed this and we're owed this and we're owed this and we're owed this, and then you've got the police chief there and the fire chief. And they say, well, if you don't pay our pensions, I don't know if I can put out the fires or keep the streets safe. Who are you going to pay? You're gonna pay the people who, because you have to recontract with those people. You have to see those people tomorrow. You're not going to be able to just fire them all and get new ones. So I think there is a real problem with the debt, all this pension debt being owed to people who are providing essential public services.
Yeah.
Can I make a final?
Please.
So, the thing I would want to leave you with, in Illinois, at the state government level, 25 cents of every dollar of government revenue is going to pension contributions. And it doesn't require, I think, for Illinois, a lot of stochastic modeling and things like that to recognize that that's just not acceptable, particularly when you recognize that it's not even enough to stabilize the situation on a variety of different measures of what would be stabilized. So I think the policy prescription is pretty clear. It is to go to defined contribution plans, and as a start, maybe do that without impinging on the accrued benefits of people who have earned them. Even that is something that we haven't been able to get done. You haven't been able to get that done in this state, and I think it goes to the political power of unions. Maybe though, what you're saying is right, Ed, that you need to figure out a way of offering them something that will be appealing to them. And I actually believe that defined contribution plans with a pretty high percentage of pay on the employer side would be appealing to particularly younger members and unions. They would say, hey, wait a second, actually having 10% or 15% of my pay pre-tax in an account every year is actually worth quite a bit, especially if I'm only planning on working for the government for 5 or 10 years, something like that. So that's the simple policy prescription direction we need to go.
Yep.
Politics make it a lot more challenging.
I guess there's one part of all this I'm a little bit confused by, but there was this claim that if we go through and we explain people the potential benefits and like this, they'll be more willing to pay out the taxes and the like. How does that jibe with the kind of uncritical support for teachers' union bargaining and all these schemes? I mean, if those deals aren't good deals for the public, it seems to me like, why is there uncritical support for those type of deals? I mean, it just seems to me remarkable. Part of the power of the public unions has to do with the fact that there's public support for them in a really uncritical way. So is it just really explaining to people what the
But how wide is the
benefits
support?
are?
You mean even during this latest strike in Chicago, there's a lot of support for that? I'm not so sure, but I don't know.
I didn't see a lot of outcry against it. I saw remarkably little, actually. But anyway, let me go on. I'm going to shift to the audience questions here. The first one's for Carol. What is the near-term nightmare scenario in Illinois, given political unwillingness to reform now and likely? What's the likely scenario?
Well, it depends on whose nightmare, I suppose. If the economy tanks anytime soon, if there's a stock market crash and the pension assets that are existing plummet, then the current law that requires pension contributions to meet that Edgar ramp is going to require even more coming in to the pension systems from the state. At the same time that, because there's been economic problems, the state's revenue are going to be dropping, especially if we're relying more heavily on the higher income folks, because in downturns, their income is more volatile. And so in times of financial downturns, the high-end people, I mean, you don't feel terribly sorry for them, right? Their income went from 100 million to 2 million, poor you. But when the state's relying more heavily on them, it's going to be, so we're going to have a drop in pension values, which means no more money needs to go in there. Less revenue coming in for the state and greater need for the state services that we have out there, the safety net type services that the state is having a hard time paying for because of the fiscal democracy problem. I guess that's the nightmare scenario for me.
I think this is for multiple people. Have any public pension plans successfully encouraged older workers to continue working rather than to retire? It seems to me that would be, we might want the opposite, but anyway. Has public employee headcount been accurately predicted by anyone, and how significant is this figure? So I guess the question I would think here is, what are the right incentives? What incentives are there for older workers versus younger workers, and do we have those incentives right in terms of the current pension plans?
So the DB structure, the defined benefit structure, has always had this problem where you actually often max out at some point and you start getting very negative. It's not just the young, it's the very old. We get very negative benefits, even in the old structure. And actually, believe it or not, some of the reforms, because they pushed out the retirement age, and they've often lowered or minimized the extent to which you had that push of older workers out in the old systems. They still have it in a lot of cases because of the defined benefit structure. Maybe now it's at 65 and it's not at 60, and maybe it's not. not as great. And if it's modest at that age, the people who want to work often are not, just like the young, are not necessarily that incentivized by the fact they're only getting their cash wage, or they're getting cash wage minus a few percent. So I think you've actually had, almost any of these reforms have actually gone somewhat in that direction. But reform should be designed to get rid of this problem. I see the demand for older workers being increased enormously in the future, simply because somebody's got to start filling in the workforce. And which another little factoid is, in the Great Recession, the only group that had increased employment rates was the 65 to 70-year-olds by age. So there's some movement beyond state employment for older workers to work. There's a lot of incentives both on the supply and the demand side.
So here's a question. Wisconsin's plans are much better funded than Illinois plans. What is Wisconsin doing right?
Well, I've written some work. I've written a paper about Wisconsin. So one of the features that Wisconsin has in its state pension system is that there is some risk sharing that the pension beneficiaries have, which is to say that if the stock market goes down, if you're a retired public servant in Illinois, you don't see your pension go down. But if you're a retired public servant in Wisconsin, you might see your pension go down, depending on by how much the market went down and when you enter and what formula you're under. And so that's one of the reasons. There's always been something about the accounting, however, of these plans that I've found a little bit, I personally find it impenetrable, but maybe someone here can help me with it, where I've suspected that the actual funding ratio is overstated by the accounting methods that they're using. But the fact is that this cost risk sharing is something that it imposes costs on the retirees relative to the retirees in Illinois who don't see their pension benefit go down when the stock market goes down. But it does mean that the system is better funded.
Carol, did you talk about
No, I just
Wisconsin?
assumed that I didn't realize that. I assumed it was just purely the employers putting aside adequate, the real normal costs during the time that the employees were working. So the taxes were aligning with the actual services being performed instead of what we're finding now, which is taxes today paying for services performed 20 years ago.
Wisconsin shows you don't have to go all the way to a DC plan. The one advantage the state has over any private business is they're going to be there forever. So in some sense, they can share risk across generations. Like they could promise you the average rate of return as it actually occurs over time. You still get the risk sharing, but you could share it across generations a little better sometimes than you can with DC plans if you think rates of return are going to bounce around.
I sort of agree, although I'd say to the young people in here, be careful when you hear older people say intergenerational risk sharing. That means we take the risk and you bear the cost if it goes badly.
Touché.
So here's another question. Governments are often tempted by pension obligation bonds as a way to deal with liabilities in the short term. What are the long-term effects of these bonds?
Oh boy, me again. Okay.
We want to rise to this
Well,
one?
the temptation comes from the idea that the yield, the rate that the governments have to pay on these bonds is typically substantially below the rate that they're assuming, the rate of return they're assuming they're going to get on the assets that they're going to invest the money in. So it's basically, I'm going to issue, say, I don't know, $100 million. I'm going to have to pay 4% coupons on that $100 million. I'm going to invest it in my pension fund where I'm assuming a 7.5% rate of return because I'm investing in the stock market and private equity and things like that. And that allows me to sort of book a kind of profit, if you will. And so that is a temptation that is very, 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 very problematic. And it is a very risky strategy that should generally be avoided. I will add that, if a government were going to show that they had totally stopped all new pension benefit promises from being made, then I think that one might want to practically open up a little bit more of the channel of possibly allowing the government to do some borrowing to bridge if you're going to go over to a defined contribution plan, for example, there's this transition cost. Some borrowing for that might be feasible, but I wouldn't want to see it until they stopped racking up new unfunded promises.
The governor is attempting to consolidate pension plans. Is there any financial benefit from doing so? If so, how much?
Off the top of my head, there was a big study talking about what they estimate it's going to be. But they didn't have any actuaries working on it, so there's not the detailed level of confidence that some of a lot of good government groups out there are struggling with. I mentioned the expectation is that will be improved rate of return by a basis point or two, or 100 or two, and then the saved administrative costs. So if that's all they do, the problem is there's some transition costs, and their investments sometimes are. We don't know. How's that for? I don't know.
Is that because of better fund management? Why this higher rate of return?
Well, I mean, some of those funds have $10 million in them. And
Yeah.
so their ability to invest in some of the larger scale, larger scope things
I see.
is,
So you
and
think
their
it can
ability to
expand the market.
Yeah, I mean that's
Okay.
what the thinking
And you might
is.
hope they'll engage in a little bit less malfeasance in various ways. If you have some
No,
degree of oversight.
Fewer
and
mayors will be
the-
hiring their brother-in-law
Yeah.
to manage.
Well,
the
but it's going to the
investments.
state where there's massive malfeasance.
Indeed,
so
indeed.
I'm not
You're-
sure.
Not there though, not in that area.
There's also much better risk sharing. I mean, some of these plans are so small that they're completely exposed to shocks because their population is so small. If you make the pool bigger, they're less susceptible to that, and that's an obvious benefit.
Yeah, I mean, there's some
think.
state law even limiting the way they can invest their funds when they're so small, and so some of that will go away once it's a big pooled fund.
So I'm trying to consolidate all that we've learned from this panel, and I'm happy to have the panelists chime in if I've misrepresent things, which I'm sure I will, since this is my own lens. It seems to me like it's been very fascinating to learn about the challenges which we're facing as cities, states, and the like. We've exposed, I think, some very important questions. We've exposed some of the key assumptions underlying calculations. We've discussed what potentially better policies might be going forward. I'm not 100% sure I yet understand the politically feasible way forward, although I would be. Although we've certainly got some hints in terms of strategies for how to do that. But this is no doubt a tremendously important challenge that we as a society face, and we as a government, states, and locations face. So I've been very appreciative of all the panelists and all their perspectives as well. Before closing, if there's any kind of final statement anyone would like to give, I'm certainly open to that.
I think I'd just like to point out again, it follows my comment on Josh's comment earlier, which is that Chicago does not have any kind of success that is preordained. There were 4 American cities in 1950 in the Midwest that were in the top 10. Of those 4, 3 of them have lost more than 50% of their population since then, right? Cleveland, Detroit, St. Louis. Through the combination of being the largest agglomeration of the Midwest and a variety of other sort of fortunate things, Chicago managed to do significantly better than those cities. But it does not have the weather that ordains California's growth. It does not have the preponderance of ultra-high skills of Seattle or Massachusetts, right? And so this region cannot run a crappy government, right? It's a very, very costly thing, right? People will move out. There's nothing that actually is guaranteed here. And it is amazing that so many things go wrong in terms of Illinois' government relative. It's not, and just to be clear, just a level set, right? This is not, you're not Louisiana or Mississippi, right? This is not which are perpetually lead the nation in corruption cases. But it could be a lot better. And indeed, that's the sort of stake at this, that this is part of a larger issue, which is good government for the state of Illinois. And it's something that is absolutely vital, and it's something that only occurs if everyone here also invests.
So what I very much hope we can do is help educate the public in the future about there's costs and benefits to facing these financial challenges, and costs and benefits to government funding and programs, and it's really important to face up to these financial challenges rather than hide them under the rug and the like. Did you want to add anything, Jim, as we close? Or?
No, I want to thank everybody for staying so long, actually. It's been going on quite a while. I've been listening to various, probably some repeated lines. But I do think, I am a little sad that we don't really have a good conclusion here. We don't have a conclusion. We don't have a point. We're not going to march out with a banner and reform Illinois. And I think a lot of these issues, they are political, and we say that. And so economists will typically say, well, it's not our domain. But it is in some fundamental sense in this case. I mean, I don't see how you can undo that link between the politics here. The people have talked about, machine politics, and a lot of cities that have had these problems have been kind of dominated by one party type rule, and there's been all this corruption, at least in Chicago and Baltimore, and the cities better than I, but there is a question about trying to get the cities more accountable and engaged. But I don't know the way to do that.
Yeah. Anyway, with that, I would like to thank all the panelists for your participation, and I thank the audience. I agree with Jim. Thank you for staying through such an informed discussion. And I look forward to having these conversations continue informally or in other forums. Thank you.